Michael Burry has consistently profited enormously from significant market crashes. The market has already fallen significantly, but according to Burry, this is just the beginning of a much bigger fall. He predicts that the market will drop more than 50% from current levels. Today, we'll discuss what Burry thinks of the market and how you should manage your risks according to Burry. Although nearly a year has passed since Burry's first prediction in 2021, things have happened exactly as he predicted. Burry foresaw accelerated inflation, the demise of growth stocks, a general market correction, and falling bond prices. Human nature's predictability is one of the reasons Burry was able to foresee market catastrophes. History demonstrates that human behavior has not changed regardless of technological advancement. Michael Burry's observation of some unsettling fundamentals supports his prognosis. The dismal macroeconomic scenario is well known. Some economists will predict that the situation in Ukraine and Russia is about to collapse, while others will assert that China's economy is fragile or that interest rates in the US are still rising. Despite the possibility that each of those scenarios is real, there is only one element that can lead to the collapse of the economy: the customer. A consumer's weakness at some time will cause the entire economy to collapse because the consumer drives the economy almost entirely. 7.1% of the US GDP comes from personal consumption expenditures alone. The economy will crash if we all stop consuming and start conserving. Burry added, this is the issue over the previous 18 months. Less $800 billion in direct stimulus checks, $400 billion in refinancing, over $1 trillion in forgiven debts, $250 to $500 billion of which were fraudulent, another $4 trillion in indirect payments, etc. Currently, what recapitalizes the consumer? Pay raises won't accomplish that. Consumers feel that their money is worth much less as a result of the economy's rapid price increases, and there is plenty of statistics to support this claim that consumers are weaker than ever. The Consumer Expectations Index from the University of Michigan is the most well-known indicator of consumer behavior. The fact that consumer expectations are at an all-time low and that Amazon's revenue growth is slowing down are both indicators of weaker consumer demand. Amazon's first quarter results were dismal, with revenue increasing by only 7% year over year, and the majority of the revenue virtually absent. In the tech era, Amazon has taken over as the primary marketplace where most people buy their goods. Consumers are in an exceedingly precarious situation, as seen by Amazon's dismal quarterly financial results. Consequently, how did Burry amass millions, and how may investors replicate his success? Burry predicts that firms will struggle to retain double the rate of return as the first economic impact of weaker consumers. Burry anticipates employing bond shorts to make millions, if not billions of dollars in the upcoming year. He stated, among other things, that he was selling 30-year Treasury bonds in late 2021. For what it's worth, I've never shorted any coin. This is my third bubble and the biggest. I've learned a thing or two from 30-year Treasuries, he posted on Twitter. On the other hand, it is quite clear why Burry is shorting bonds. Bond investors were sure to lose 5% annually when inflation surged to around 7%, while the return on 30-year bonds was still just about 2%. Bond rates and bond prices have a short-term inverse relationship, which causes bond prices to decline as yields rise. TBT is a fund that invests in ultra-short 20-year Treasury securities, and it's one of the funds that Burry purchased. TBT offers a variety of bonds. Bond yields have increased dramatically during the previous few months as a result of rising interest rates, inflation, and the current situation in Ukraine. This has caused bonds to decline and TBT to rise. The TBT fund has increased by more than 43% since it initially opened a short position, which is a sizable gain. But Burry anticipates future gains to be substantially greater. Burry most recently tweeted, "1977 says hello," along with a picture of himself from that year. It made reference to the state of the economy in the 1970s. The 1970s are referred to as the Great Inflation Era because of the high amounts of inflation at the time. Inflation peaked in 1980 at almost 14%, up from a rate of 6.5% in 1977. This is fairly comparable to how things are now. Burry predicts that inflation, which is currently at 8%, might eventually rise to 10% or even 15%. In fact, it's possible that inflation has already risen above 10%. The Consumer Price Index, which is used to calculate inflation, is disputed by Burry. He clarifies here, the CPI reports that housing costs increased 5% in the previous year. Using actual NAR housing data, the incorrect CPI is 12. Since home prices have been an issue for so long, BLS has always smoothed out housing data. Therefore, they'll begin adjusting vehicle rates next month, thus solving the issue. Burry is basically claiming that the data used to calculate the CPI is far behind. The CPI number suggests that housing prices increased by only 5% last year, which is undoubtedly false. If you use real data to compute the cost of housing, CPI inflation would be at 12%, which means that the present inflation rate of 8% is 4 percentage points higher than the true rate. This error in judgment, along with other macroeconomic variables, would result in a market collapse of around 55% of present price levels. Burry clarified, the speculative peaks and paradigm shifts. The S&P 500 bottomed at 13 lower than it did in 2002. 2009 saw 17 decreases from the LTCM crisis low in 2002 and 10 decreases from the bottom of the 1970s in 1975. SPX 1862 is 15 lower than the current low. According to historical data, the nominal price-earnings ratio is 9 and the Shiller PE ratio is around 16. If we assume that the pattern of market crashes identified by Michael Burry persists, the S&P will tumble to a level that is only marginally lower than the collapse connected to COVID. Burry uses 15 as an example here to see if it would theoretically make sense if the S&P collapsed to 15 below this previous low during COVID. At that point, the index would be at about 1,800 points, which is about 55 below current levels and would return it to historical price levels. The Shiller PE ratio through time is depicted in one of the figures that Burry added to his tweet. The Shiller ratio is a cyclically adjusted price-to-earnings ratio, which means that it takes inflation into account when adjusting the price-to-earnings ratio. Shiller's ratio is currently 36.55. A decrease would bring it to roughly 16, which is in line with the historical norm. Burry also included a graph showing the nominal PE ratio, or price-to-earnings ratio, over the previous 12 months. The current PE ratio is 21, and a 55 collapse would roughly translate to a value of 9. A PE of 9 would be somewhat below average, which makes sense in Burry's opinion. All of this supports his assertion that the discomfort has not yet diminished. Some of you believe that short-term crashes don't matter if you own stocks over the long term. If you can handle the emotional pain of seeing a sizable decline in your portfolio, this is unquestionably true. Great businesses consistently face short-term setbacks and generate long-term profitability. Amazon during the dot-com bubble is one illustration. Burry inquired, how long can a good expanding company's stock go? One destined to rank among the top businesses in the world. Do you recall when Amazon plummeted by 95, but the Fed? The Fed did not then have to worry about inflation to this extent. Perhaps the stock market isn't for you if you can't maintain confidence in a stock that is down more than 95%. All investors experience emotional reactions to short-term volatility, and managing those reactions can be quite challenging. Speaking of volatility, trading volume is another indicator of further collapse. During market crashes, trading volume increases as buyers increase their buying and selling activity. There has never been a trading volume of outstanding stocks this low. Burry has provided a thorough explanation of every step of what takes place. By 2002, Microsoft traded 5.2 times its outstanding shares. By 2009, 3.3 times, and thus far, 0.5 times. By 2002, Amazon had traded 5.7 times. By 2009, 6.6 times, and thus far, 0.9 times. By 2002, JP Morgan had traded 3 times, 5.9 times by 2009, around 0.7 times thus far, etc. The trade volume still has to expand 5 to 10 times from current levels, which takes time. This is because the market tends to have more trading volume when prices are lower. Thus, the trading volume still needs to rise dramatically in order for the market to resemble prior crashes. That concludes today's video, which we hope you enjoyed. Comment on Michael Burry's predictions and your own preparations for a potential stock market crash. Let us know what you think. Thanks for viewing, and we'll see you soon.